The U.S. government is drowning in debt. Over $14 trillion needs refinancing soon. One new proposal suggests solving that problem using Bitcoin-enhanced bonds. These bonds combine traditional treasuries with a small allocation to Bitcoin. They could cut interest costs and grow a strategic Bitcoin reserve at the same time. Let's explore how this idea works, and whether it could actually make sense. In 2024, former President Trump signed an executive order encouraging the U.S. to build a strategic Bitcoin reserve. This directive asked federal departments to find ways to accumulate BTC without increasing taxes or spending. It planted the seed for what would later become the Bitcoin bond concept. Enter the Bitcoin Policy Institute, a crypto think tank. They recently published a detailed policy brief proposing a new kind of government bond, one that blends U.S. treasuries with Bitcoin exposure. The idea is to help the U.S. refinance its growing debt more affordably. Today, interest rates are much higher than they were just a few years ago. As the government rolls over trillions of dollars in old debt, it's facing significantly higher interest payments. That's why lower-cost financing tools are urgently needed. Bitcoin bonds could be that tool. By lowering the yield required from investors and offering upside through Bitcoin, these bonds might attract fresh capital without putting more pressure on taxpayers. The political foundation has already been laid, and now the economic need is pushing this idea closer to reality. At their core, Bitcoin bonds are a hybrid instrument. Each bond would be made up of 90% U.S. treasuries, offering a modest yield, say 1%, and 10% Bitcoin to sweeten the deal. This structure reduces borrowing costs while giving investors exposure to a high-growth asset. Here's how it works. The investor gets all of the Bitcoin return up to a 4.5% annual yield and half of any additional Bitcoin gains. The other half of those extra gains goes to the U.S. government's Bitcoin reserve. Let's say someone invests $10,000 into a Bitcoin bond. $9,000 is used to buy treasuries, which return a small yield. The other $1,000 buys Bitcoin. If Bitcoin performs well over the 10-year term, the investor could see much higher total returns. Because Bitcoin returns are historically strong, even a small exposure can offer significant upside. Meanwhile, the treasury portion protects the investor's principal, even if BTC performs poorly. This combination offers a balance of security and opportunity, making it attractive to a wide range of investors. Bitcoin bonds are designed for conservative investors who want some exposure to crypto without taking on full market risk. The 90% treasury allocation ensures capital safety, while the 10% Bitcoin provides asymmetric upside. The structure also guarantees a minimum yield through treasury interest, while offering a potential kicker if Bitcoin rises. Even in a worst-case scenario where Bitcoin goes to zero, the investor still receives their initial investment back over time. If Bitcoin performs modestly, say a 10% annualized return over 10 years, that small allocation could grow more than 2.5 times, enhancing overall bond returns significantly. The appeal is clear. Capital protection from the treasuries and long-term growth potential from Bitcoin. Few traditional investments offer both in one package. It's an especially compelling option for investors who want to hedge against inflation while still playing it relatively safe. Let's look at the potential fiscal impact. If the U.S. refinanced $2 trillion of debt using traditional treasuries at 4.5%, it would pay $90 billion in interest annually. Over a decade, that's $900 billion in payments. By switching to Bitcoin bonds with a 1% yield, annual interest drops to just $20 billion. That's $700 billion in savings over 10 years, without cutting spending or raising taxes. And then, there's the Bitcoin accumulation. Under conservative projections, the U.S. could acquire over 2.2 million BTC by 2035, an 11x increase from its current holdings. If Bitcoin hits $1.25 million by then, that stash would be worth $2.7 trillion. That's a significant national asset that could even be used to offset future deficits or economic emergencies. This dual effect, lower interest costs and asset accumulation, makes Bitcoin bonds a powerful strategic tool. Bitcoin volatility is the biggest risk. While only 10% of the bond is allocated to BTC, that exposure could still cause concern for more risk-averse investors or institutions. There's also the risk that large-scale BTC buying could inflate prices dramatically, making future bonds less cost-effective. The authors propose strategies like dollar-cost averaging and OTC purchases to ease this. Custody is another challenge. Managing large government-owned Bitcoin holdings comes with technical, legal, and cybersecurity risks that must be addressed upfront. Regulatory classification could also become a sticking point. Since the bonds combine a commodity and a security, new legislation might be needed to clearly define their status. To address all of this, the proposal suggests starting with a $5 10 billion pilot program over 3-6 months to test the structure in a controlled environment. If Bitcoin bonds become reality, they could create new buying pressure for Bitcoin and reduce its available supply. Unlike ETFs, Bitcoin held in bonds wouldn't be frequently bought or sold, leading to longer-term price impacts. As demand for Bitcoin bonds grows, so does the demand for Bitcoin itself. That could drive prices up significantly, especially in early adoption phases or bull markets. There's also a broader economic effect. As Bitcoin bonds lower demand for traditional treasuries, overall treasury yields could fall. Lower interest rates often lead to risk asset rallies, including in crypto and equities. Increased government participation in Bitcoin markets would also raise its legitimacy, potentially boosting institutional adoption of crypto across the board. Still, sharp BTC price moves could also bring more volatility, both for the bonds and for the broader crypto ecosystem. Here's the thing. You don't actually need a Bitcoin bond to execute this strategy. You can build your own version. Buy 90% treasuries, 10% Bitcoin, and manage the portfolio yourself. Doing it solo means you keep all of Bitcoin's upside. You'd still earn the 4.5% yield from treasuries rather than the 1% yield baked into the proposed bond structure. You could also take it a step further. Use crypto-native tools like yield-bearing stablecoins and DeFi protocols to create a fully digital version of this barbell strategy. This DIY method benefits not just investors but the U.S. government too. The more demand there is for stablecoins backed by treasuries, the more the U.S. debt is indirectly financed. So while Bitcoin bonds are a clever policy idea, individual investors may be able to achieve similar or even better results with existing tools. Bitcoin bonds are an innovative attempt to solve two problems at once: rising debt costs and crypto adoption. If implemented carefully, they could save the government billions and transform Bitcoin's role in global finance. But even without them, combining treasuries and Bitcoin remains a powerful investment strategy. Whether through policy or personal portfolio design, this hybrid approach is worth serious consideration. Thanks for watching. See you in the next one.